Inventories, LIFO liquidation illustration. Now, in LIFO liquidation, what is happening that if we have in LIFO liquidation illustration, example 6. Now, we need to understand what is happening in LIFO liquidation. For example, if these are our inventories, our older inventories would be cheaper if the prices are increasing, and most recent inventories would be expensive. So if we are selling more, if our sale is more than our purchase, then it means that we are eating away into our older inventory, and older inventory is cheaper. That will going to reduce our cost of goods sold. That will ultimately increase our gross profit. Now, in order to show higher gross profit, that will again show a higher net income, companies might be involved in LIFO liquidation. Now over here, Reliable Pants, a hypothetical company, sells high quality pants and has been in business since 2015. Exhibit 14 provides relevant data and financial statement information about RFs or Reliable Pants inventory purchase and sales of an pan inventory for the year 2015 through 2018. Reliable Pan uses LIFO method and periodic inventory system. What amount of Reliable Pan's 2018 gross profit is due to LIFO liquidation? Now over here, in 2015 we purchased 12,000 pans. Each fan was for $100, and we sold 10,000 pans, and the sale of each fan was $200. So if we have purchased 12,000 fans and we are selling 10,000, then in our inventory 2,000 fans are left. And it can be seen as well that in our inventory we have 2,000 fans. So 2,000 multiplied by 100 equals to 200,000. Our cost of goods sold is 100,000 because we sold 10,000 fans and each fan is for $100. So our cost of goods sold is 10,000. And our gross profit would be 1 million because we sold 10,000 fans for $200. Our sales would be 2 million, and our cost of goods sold is 1 million. Now in 16 and 17, what is happening that fans unit sold was 12,000 and we purchased 12,000. So whatever we purchased, we sold, and we are following last in first out method. So the recent purchase will be sold first. In 2017 as well, we purchased 12,000 and we sold 12,000. So this is the amount we purchased and this is the amount we sold. So till this point, we are still left with this inventory of 2,000 that was worth $100 each. Now in 2018, something interesting is happening that we are purchasing 12,000 fans, but we are selling 13,000. It means that we are eating away into older inventories. So if we have purchased 12,000 and we are selling 13,000, so our net result is minus 1,000, and this minus 1,000 is coming from these 1,000 fans are coming from 2,000 fans from previous inventory. Now we are selling 1,000 fans extra, and over here the purchase price 15 and over here the purchase price is 100, so the difference is of $15. So 15,000 would be the difference. Now if instead we would have purchased 13,000 fans instead of 12,000, then our cost of goods sold will increase by 15,000. But over here, because we are eating away into our older inventory and we are using for 1,000 fans, we are using cost of goods sold as the purchase price as 100. So this will going to decrease our cost of goods sold. Now over here, our cost of goods available for sale is 1.58 million. Now the purchase price is 1.38 million. The total purchase would be 1.38 million. So 12,000 multiplied by 115 equals to 1.38 million. And our cost of goods sold is 1.48 million. Not only we have sold 1.38 million, but we also sold $1,000 fans for $100 each. So this is 10,000. 1,000 multiplied by 100 would be 10,000. So 1.38 million plus 10,000 is 1,000 multiplied by 100 equals to 100,000. So if 1.38 million plus 100,000 is 1.48 million. So this is our cost of goods sold. And our gross profit would be 1.315 million because our sales equal to 2.795. So we are selling 13,000 fans for 215. So 13,000 multiplied by 215 equals to 2.795 million. Our cost of goods sold is 1.48 million and our gross profit is 1.315 million. Out of this gross profit of 1.35 million, 15,000 is because of LIFO liquidation, and the reason being is that the cost of goods sold we are showing of this 1,000 fan is saving us $15. Why? Because right now the purchase price is 15, but we are using the purchase price of 100, so we are $15 up. So our saving equals to 15,000. Now, Reliable Fans reported gross profit for 2018 is 1.315 million. Reliable Fans 2018 gross profit due to LIFO liquidation is 15,000. Again, because of the extra 1,000 fans that we sold, we are taking $100 as the cost, but instead at this point the cost is 115. If we would have purchased extra 1,000 fans for 115, so our cost would be 15,000 more, but because that is not happening, our cost is 15,000 less. Accounting for decline and recoveries of inventory value. Example 7. Hatsumi Enterprises, a hypothetical company, manufactures computers and prepares a financial statement in accordance with IFRS. In 2017, the cost of ending inventory was 5.2 million. So in 2017, the cost was 5.2 million and net realizable value equals to 4.9 million. The current replacement cost of the inventory is 4.7 million. So replacement cost equals to 4.7 million. This figure exceeds the net realizable value less a normal profit margin. So this figure exceeds the net realizable value less normal profit margin. In 2018, the net realizable value of Hatsumi inventory was 0.5 million greater than the carrying amount. So in 2018, 0.5 million worth of recovery took place. Now, what was the effect of write down on Hatsumi's 2017 financial statement, and what was the effect of the recovery on Hatsumi's 2018 financial statement? So, if we are using IFRS, then we will going to choose lower of cost or net realizable value. So lower is 4.9. So the inventory would be written down to 4.9 million and the loss of 0.3 million. Now and record the change in value of 0.3 million as an expense in the income statement. Now 0.3 million would go in income statement. Hatsumi would increase the carrying amount of its inventory and reduce the cost of sales by 0.3 million. Now in 2018, recovery took place, but you need to understand the recovery can only take place to the amount of original write down. So our original write down was of 0.3 million. Hence, the recovery would be only of 0.3 million despite the fact that the inventory gone up by 0.5 million. So the carrying amount of the inventory would increase by 0.3 million and the cost of sale would be reduced by 0.3 million. So in 2018, inventory would go up by 0.3 million and cost of sales would go down by 0.3 million. Under US GAAP, now you also need to understand that in US GAAP, write-up is not allowed. So if Hatsumi used the LIFO method, what would be the effect of the write-down on Hatsumi's 2017 financial statement and of the recovery on Hatsumi's 2018 financial statement? As we have learned, recovery is not allowed in the US GAAP, and the inventory in 2017 would be written down to the recoverable cost, that is 4.7 million. So under US GAAP for 2017, Hatsumi would write its inventory down to 4.7 million and typically include the change in value of 0.5 in cost of goods sold on the income statement. For 2018, Hatsumi will not reverse the write-down. Part 3. What would be the effect of the recovery on Hatsumi's 2018 financial statement if Hatsumi's inventory were agricultural products instead of computers? Now, Hatsumi's inventory were agricultural products instead of computers. Inventory would be measured at net realizable value and Hatsumi would therefore increase inventory and record a gain of 0.5 million for 2018. This is specifically for agricultural products. Effect of inventory write down on financial ratios. The Volvo Group, based in Gothenburg, Sweden, is a leading supplier of commercial transport products such as construction equipment, trucks, buses, and drive systems for marine and industrial applications, as well as aircraft engine components. Except from Volvo's consolidation financial statement are shown in Exhibit 5 and 6. Notes pertaining to Volvo's inventories are presented in Exhibit 7. So this is our financial statement, and in our notes we are told that inventories are reported at lower of cost and net realizable value, and net realizable value is calculated as the selling price less cost attributed to the sales. The total inventory net of inventory obsolescence allows 52701 as of December and 48,287 as of December 31st, 2016. Now this is our allowance for inventory obsolescence. So these are our allowance, and we need to understand in the first, from 2016 to 2017, the allowance reduced by 194, and from 2015 to 2016 the allowance increased by 59. Now what inventory value would Volvo have reported for 2017, 2016, 2015 if it had no allowance for inventory obsolescence? Now our inventory for 2017, 2016, 2015 is 52701, and it has already included allowance. Now if it had not included allowance, then we would have added our allowance. So this is inclusive of allowance. If we want to find out total inventories without allowance, then we would add our allowance for inventory obsolescence. Now it makes sense because allowance for inventory obsolescence means that the inventory that we are unable to sell. So if we are doing it without allowance, so we would add our allowance for obsolescence. Now assuming that any change to the allowance for inventory obsolescence are reflected in the cost of sales, so reflect in the cost of sale, what amount would Volvo's cost of sale be for 2017 and 2016 if it had not recorded inventory write down? Now cost of sale without allowance minus cost of sales without allowance, add change in valuation allowance equals to cost of sales with allowance. Now it makes sense. If the valuation allowance goes up, it means the cost of sales would increase. Now if this is cost of sale without allowance and the valuation allowance is going up, this will going to increase our cost, because again valuation allowance is the amount of inventory that we are unable to sell. It is a negative thing, so it will going to increase your cost. Now we can tweak this equation. We say cost of sales without allowance equals to cost of sales with allowance minus change in valuation allowance. Now our cost of sales without allowance is given as 254,581, and our change in valuation allowance was minus 194. So minus that will be added. In 2016 our valuation allowance increased by 59. So over here we can see that the valuation allowance increased by 59. Over here the valuation allowance decreased by 194. So over here, if the valuation allowance in 2017 is decreasing by 194, so we will going to add it according to this equation. In 2016 we will going to subtract it. Why? Because the valuation allowance increased. So this is our cost of sales without allowance. What amount would Volvo's profit be for 2017 and 2016 if it had not recorded inventory write down in 2017 and 2016? Volvo's effective income tax rate was reported as 25% for 2017 and 31% for 2016. Now this is our profit with allowance. So if without allowance, if our cost of goods sold over here has increased, over here our cost of goods sold, if you see, the cost of goods sold have gone up from 254,581 to 254,775. So if our cost of sale is increasing, that will going to reduce our profitability. And by how much the cost of sale is increasing? So cost of sale is increasing by 194. So this will going to reduce our profit. So $194 will be reduced from our profit. But because the profits are being reduced, we will also going to save taxes. How much taxes we're going to save? Equals to 194 into 0.25, that is equal to 49. So the total profit without allowance would be 21138. Now in our second scenario, our cost of sale without allowance actually has gone down. So if our cost of sale has gone down, so it will going to increase our profitability. If our profitability increases by 59, our taxes also increases. So 59 multiplied by 0.31 will going to give us the increase in taxes, that is 18.29, approximately 18 over here, 18 million. So our profit is 13264. What would Volvo's 2017 profit have been if it had reversed all past inventory write down in 2017? So in 2017, what's our valuation allowance? It's 3489. So if 3489 is reversed, what will going to happen to our cost? So reversing is a positive thing, so it will going to reduce our cost of sales. So if our cost of sales goes down, our profitability increases. So our profit is 21283. So if cost of sales goes down, our profit will going to increase by the valuation allowance, that is 3489. Because our profit is increasing by 3489, we need to pay higher taxes. So 3489 multiplied by 0.25 will going to give us 872, and this is our profit after recovering of previous write-downs. Now in part 5, we need to come up with different ratios and compare with allowance and without allowance. So we have inventory turnover ratio, days of inventory on hand, gross profit margin and net profit margin. Now if you recall, inventory turnover ratio is cost of sales divided by average inventory. Now cost of sales as per with allowance equals to 254581, and this is our average inventory. So if you go back and see, our cost of sale was 254581, and without allowance it is 254775. So over here we have 254775, and these are our inventory and these are our turnover ratios. From turnover ratios we see that it seems that with allowance actually gives us a higher ratio, and it might show that the company appears to be managing its inventory more efficiently when it has inventory write-downs. Now inventory write-down is higher based on the numbers as reported, because inventory carrying amount will be lower with an allowance for inventory obsolescence. This inventory would be lower because of inventory obsolescence that will going to increase our turnover ratio. Days of inventory on hand is 365 days divided by turnover ratio. Again, because turnover ratio is better with allowance, it shows lower days. Our gross profit margin is gross income divided by net sales. In our previous example, our gross profit was 80167 and this was our sales 334748. Now without allowance, we showed that cost of sales without allowance went up because the valuation allowance actually went down by 194. So if valuation allowance is going down, that is going to increase our cost of sales. If cost of sales is increasing, that will going to reduce our gross profit. Hence, this is the reason why we are subtracting 194, because our cost of sold in the case of without allowance is increasing. Because cost of sold is increasing, this will going to reduce our gross profit by the same amount, that is 194. And again, in this instance, the gross profit margin is slightly higher with inventory write down because the cost of sale is lower. Now, we need to be very vigilant. This is because of reduction in the allowance for inventory obsolescence. Now, if this was not a reduction, but it was an increase in valuation allowance, then without allowance would actually have shown a better ratio. Net profit margin, as again we have calculated profit for without allowance. So, in without allowance, our profit was 21138. Why our profit was lower? Our profit was lower because, as we have seen, our cost of sale actually went up. The reason why in 2017 the cost of sale went up was because there was reduction in valuation allowance. This is again the rationale behind what is happening in the ratios. Now part 6, CAT in example 5 has no disclosure indicative of either inventory write down or cumulative allowance for inventory obsolescence in its 2017 financial statement. Provide a conceptual explanation as to why Volvo incurred inventory write down for 2017 but CAT did not. Now before starting this question, we need to understand that Volvo is using first in, first out. Because Volvo is using first in, first out and the prices are rising, in first in, first out, inventory is higher and cost of goods sold is lower. Because inventory is higher, there is a higher chance of a write down. In last in, first out, in rising prices, inventories are lower and cost of goods sold is higher. Why cost of goods sold is higher? Because the most recent purchase, that is a more expensive purchase, are being sold first. And we have older inventories that are being showed as part of our ending inventory. Now, companies that use first in, first out inventory method are far more likely to incur inventory write down than those companies that use last in, first out method. This is because under last in, first out method, the inventory carrying amount reflects the oldest cost and therefore the lowest cost given increasing inventory cost. Because inventory carrying amount under the LIFO method are already conservatively presented, it is less likely that the inventory write down will occur. Again, as we have just discussed, in LIFO inventories are lower, hence they are already low, hence write down is less likely. But in first in, first out, inventories are very high because they depict the most recent purchase, hence write down is more prevalent. Now CAT uses LIFO method, whereas Volvo uses FIFO method. Given increasing inventory cost, companies that use first in, first out method are far more likely to incur inventory write down than those companies that use the LIFO method.